When it comes to building real wealth through dividends, investors often focus on yield, growth, or ETF selection. But there's a quieter, more psychological question that can actually shape your success over decades. How often should you get paid? Monthly or quarterly? It might sound like a small detail, but the difference between receiving dividends 12 times a year versus 4 has profound effects on compounding, cash flow management, and even your emotional relationship with investing. Today, we're diving deep into how dividend payment frequency impacts your long-term returns and which strategy truly makes you richer. Let's start with what actually happens behind the scenes when a company or ETF pays a dividend. Dividends are simply distributions of profit. Whether they're paid monthly or quarterly, the total annual amount tends to be similar. For example, if an ETF yields 6% annually, it doesn't really matter whether that's divided into 12 0.5% payments or 4 1.5% payments. Mathematically, the yield is the same. But in the real world of compounding, cash flow, timing, and investor behavior can tilt the balance one way or the other. So what's the argument for monthly dividends? The first advantage is simple but powerful: faster reinvestment. Every time you receive a dividend, you have the opportunity to reinvest it and buy more shares. The sooner you reinvest, the sooner those new shares start earning dividends of their own. This concept, called dividend compounding velocity, means that monthly payers can slightly accelerate your growth curve because your money doesn't sit idle between payments. To illustrate this, let's take two identical $100,000 portfolios. One is invested in a monthly paying ETF yielding 6%, and the other in a quarterly paying ETF also yielding 6%. Both reinvest all dividends automatically. At the end of the year, both technically earn $6,000 in income. But because the monthly investor reinvested dividends sooner, compounding starts earlier, and over decades, that timing difference can add up. If you run the math over 20 years, assuming a constant 6% yield and full reinvestment, the monthly dividend portfolio ends up worth about $321,000, while the quarterly version ends up around $318,000. That's a modest difference, roughly 1% higher, but it's still free growth created purely by payment frequency. And when you start dealing with larger portfolios, say $500,000 or $1 million, that extra 1% can mean an additional $10,000 to $20,000 without lifting a finger. But the benefits of monthly payments aren't just mathematical, they're deeply psychological. Getting paid every month provides a rhythm that mirrors real life. Your bills are monthly, your rent or mortgage is monthly, your subscriptions are monthly. So receiving dividends monthly creates a natural cash flow loop that makes managing your finances more intuitive. Retirees especially love this because it feels like a paycheck. You're not waiting 3 months between payments. You're living on a steady, predictable income stream. This regularity can also make investors more disciplined. When dividends arrive every month, it's easier to see progress. Each payment becomes a small reward, reinforcing your commitment to the plan. It keeps you emotionally engaged, and that consistency often reduces the temptation to panic sell during downturns. In behavioral finance, this is called positive feedback anchoring. You stay invested because you're constantly reminded that your money is working for you. However, quarterly dividends have their own advantages, and for long-term compounding, they shouldn't be underestimated. First, many of the most reliable, time-tested companies in the world, think Johnson & Johnson, Microsoft, or Coca-Cola, pay quarterly dividends. That's the standard in corporate America. It's not about convenience, it's about stability. These companies generate earnings on a quarterly basis, and aligning dividends with earnings reporting makes operational sense. Quarterly payers also tend to have stronger dividend growth histories. Because they're not committing to a monthly payout schedule, they have more flexibility to manage cash flow, reinvest profits, and ensure steady increases over time. So while monthly dividends might win on frequency, Quarterly payers often win on reliability and growth potential. Let's run another example. Suppose you invest in a quarterly dividend ETF like SCHD, yielding 3.8% but growing dividends at 10% annually, versus a monthly ETF like QYLD, yielding 10% but with little to no growth. After 10 years, your SCHD portfolio's income would roughly double due to compounding dividend growth, while QYLD's income would stay flat or even decline slightly if distributions fluctuate. Over 20 years, that difference becomes massive. Even though QYLD pays monthly, the growth-focused SCHD investor ends up richer, both in total portfolio value and annual income. So frequency matters, but not as much as growth rate. The power of compounding doesn't just come from how often you're paid, it comes from how quickly those payments grow. A monthly drip of stagnant income is less powerful than a quarterly payment that rises year after year. Still, there's a reason many ETF investors combine both. Monthly payers provide psychological satisfaction and cash flow stability. Quarterly payers provide growth and resilience. Together, they create a balanced ecosystem. Income consistency from one side, compounding power from the other. Let's explore how that balance looks in practice. Imagine a $500,000 portfolio split 50-50 between monthly and quarterly ETFs, half in GEPI, GPQ, or RYLD for monthly cash flow, the other half in SCHD, VIG, or DGRO for quarterly growth. Your blended yield might be around 5.5%, giving you about $27,500 in annual income. You'd receive money every month and every quarter. Those bigger payments from the growth side add a boost. It's the best of both worlds. Now, let's look at compounding from another angle: reinvestment timing. If you manually reinvest dividends, meaning you wait until enough cash accumulates, quarterly payers can actually be more efficient. However, if your platform offers automatic dividend reinvestment, DRIP, monthly payments regain the edge. The reinvestments happen automatically, often commission-free, letting every dollar start working immediately. Over 20 or 30 years, this micro-compounding adds up. It's slow at first, but relentless later. Let's dig deeper into investor psychology, because this is where the debate gets personal. Some investors thrive on the dopamine of monthly income. It keeps them motivated. Others find it distracting. They see frequent payments as noise, not progress, and prefer the calm rhythm of quarterly updates. Neither mindset is wrong, but you need to understand which one keeps you consistent. Consistency is the real currency in wealth building. It doesn't matter if your ETF pays monthly or quarterly if you can't stay invested through market turbulence. The right dividend frequency is the one that helps you sleep better and stay the course. There's also an interesting nuance around financial independence. When investors start living off dividends, monthly payments simplify budgeting. You can match expenses directly with income without constantly managing uneven cash flow. On the other hand, quarterly dividends can create natural savings buffers. Since you get larger chunks less often, you're more likely to save or reinvest part of them instead of spending them. So again, it comes down to behavior. For young accumulators, quarterly dividends can encourage long-term thinking, fewer distractions, more compounding. For retirees, monthly dividends can provide smoother income and reduce anxiety. This is why the right answer changes depending on your life stage. Let's run a quick scenario comparing total income growth. Take two investors, both starting with $100,000. One invests in a 6% yield monthly ETF, the other in a 6% yield quarterly ETF. Both reinvest all dividends. After 10 years, the monthly investor ends up with $179,000, while the quarterly investor has $177,000. After 30 years, it's $574,000 versus $567,000. The difference? Less than 1.5%. So mathematically, frequency doesn't change your life, behavior does. But here's where things get interesting. When markets crash, and they always do, monthly payers can offer more psychological stability. Even if share prices drop, your income feels consistent. Those payments reassure you that your portfolio is still generating value. That emotional anchor prevents panic selling. Quarterly investors, on the other hand, can feel more anxious during long gaps without payouts, especially in volatile markets. This is one of the quiet superpowers of monthly dividends: emotional endurance. Now let's consider the total return side. Many high-quality quarterly ETFs reinvest internally and distribute profits strategically. This can lead to better capital appreciation over time, even if your income stream feels less frequent. For instance, DGRO and SCHD often deliver double-digit annual total returns over long horizons, while monthly payers like QYLD or RYLD, despite higher yields, tend to have flat or declining share prices due to payout structures. This leads to a simple but crucial insight: yield frequency can't compensate for poor total return. Getting paid 12 times a year doesn't help if your underlying capital erodes. The real wealth comes from the combination of consistent income and asset growth. That's why sophisticated investors often design hybrid portfolios. They'll use monthly payers like JEPI and RYLD for cash flow, but anchor their core holdings in quarterly payers like SCHD and VIG for appreciation. These reinvestment-based ETFs compound more aggressively, fueling the capital growth that high-yield products often sacrifice. Think of it as an ecosystem. Income-focused funds feed your lifestyle, growth-focused funds feed your future, and together they recycle wealth. The timing of those distributions, monthly or quarterly, simply determines how often the cycle turns.